Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Veeva Systems, trading under the ticker VEEV. Veeva is executing a deliberate, highly profitable corporate transition that prioritizes integrated vertical-specific SaaS dominance over the fragmented, horizontal software models of its competitors, intentionally internalizing its infrastructure to erase historical licensing fees. However, the strategic pivot creates a structural tension as the company navigates the near-term execution complexity of migrating legacy global customers onto its native platform while establishing itself as an independent, non-discretionary, AI-driven cash compounding engine.
I mean, that thesis right there, that is a massive structural
That's
tension.
a mouthful, for sure.
It is, but it's completely accurate because for anyone watching the enterprise software space right now, this is really the definitive case study of our current era.
Yeah.
We are essentially watching this high-stakes, real-time corporate divorce play out on a global scale, and it involves, frankly, some of the most sensitive data in the world.
Right. Which is exactly why we're doing this deep dive. Because for you listening, whether you're, an allocator managing a large cap tech portfolio or maybe a software architect, studying how these multi-billion-dollar platforms evolve.
Or just someone fascinated by corporate strategy.
Exactly. This deep dive is going to be incredibly illuminating. We are looking at the absolute ultimate test case of vertical versus horizontal specialization.
That's we are.
But before we get into the messy divorce part of this, we really need to set the baseline. Because for the uninitiated who might only know, generic tech giants, what exactly is Veeva?
Well, to really understand the stakes here, you have to realize that Veeva isn't just a software company that, happens to have a life sciences division.
Right. It's not like Microsoft or someone just spinning up a pharma product.
Exactly. It is the invisible, foundational, digital backbone of the global pharmaceutical industry. I mean, when a pharmaceutical company develops a new drug, the sheer volume of data is just staggering. We are talking about managing everything from highly regulated, mission-critical FDA clinical trial data.
The actual lab results?
The lab results, the regulatory submissions, the manufacturing quality controls, all the way down to, the iPad dashboards that a pharmaceutical sales rep uses when they walk into a doctor's office.
So it's the entire life cycle.
The entire thing.
From a scientist in a lab coat realizing a molecule might cure a disease to the salesperson convincing a physician to prescribe it 10 years later.
Right. That entire decade-long journey and all the compliance, legal, and operational data associated with it that all lives inside Veeva's ecosystem.
That's a massive footprint.
It's huge. They are currently the undisputed heavyweight champion of this specific vertical. But, as your thesis pointed out, they are in the middle of executing one of the most complex infrastructure migrations in modern tech history.
Yeah, ripping out the foundation while the house is fully occupied.
That's exactly what it is.
Well, I want to get to that migration and the panic it's causing on Wall Street, but, we really can't understand the anxiety without first understanding the financial engine.
The math.
Right, the math. We have to look at what we're calling the margin expansion audit.
Okay, let's get into it.
Because the sources highlight a number that, frankly, made me do a double take. Veeva is operating with an adjusted operating margin profile of 45%.
Yeah, it's a jaw-dropper.
I mean, I've covered a lot of tech companies on this show, and you just don't see 45% very often.
No, you do not.
So let's break down the mechanics of that. How does a company doing this much heavy lifting retain almost half of every dollar as operating profit?
Well, it requires a very strict forensic look at their accounting, specifically pulling from their recent Q1 fiscal 2027 numbers.
Okay, lay it out for me.
Let's establish the top line first. Total revenue for that quarter hit $883 million.
Which is what, year over year?
That represents a 16% year-over-year increase.
Okay, so solid, steady growth?
Very solid. But the absolute bedrock of that number, the real reason the margin is so incredibly high, is the composition of that revenue.
Because it's not like one-off consulting fees or hardware sales.
No, not at all. It is highly predictable subscription revenue. In that specific quarter, subscription revenue generated $730.2 million.
Wait, 730 out of 883.
Correct.
Which means roughly 83% of their total quarterly revenue is recurring.
Yes.
That's incredible. They basically wake up on January 1st already knowing that 83% of their money is coming in the door.
And that predictability right there, That is what allows management to ruthlessly optimize their cost structure.
Makes sense.
But to get to that 45% number you mentioned, we have to bridge the gap between standard accounting and how management actually evaluates the business.
Okay, the GAAP versus non-GAAP debate.
Exactly. This requires diving into the divergence between GAAP and non-GAAP metrics.
For you listening, GAAP is generally accepted accounting principles. Basically, the standard rules of the road for the SEC.
Right. So if you look at standard GAAP operating income for that quarter, it was $273.1 million.
Okay. A very healthy number, but definitely nowhere near 45% of $883 million.
Exactly. However, Wall Street analysts and Veeva's internal management don't just look at GAAP. They look at the core cash-generating power of the software engine itself. And to do that, they exclude certain non-cash expenses.
Let me pause you right there. Because the term non-cash expense gets thrown around on earnings calls constantly, and I think it confuses a lot of people.
Sure.
Because if it's an expense, isn't cash leaving the building?
Not necessarily, and that is a really crucial distinction to make. The biggest adjustment they make is for stock-based compensation, which is often called SBC.
Right.
So when Veeva hires a brilliant software engineer, they pay them a base salary in cash, obviously, but they also give them stock options or restricted stock units.
RSUs. Yeah.
Right. Now, under GAAP rules, the company has to estimate the value of that stock and record it as a financial expense on the income statement, just like paying a utility bill.
Even though they didn't write a physical check for it, they just issued new shares.
Yes. Well, sorry, that is the core mechanic. No actual dollars left Veeva's bank account to pay that specific portion of the engineer's compensation.
It dilutes the existing shareholders slightly, but it doesn't reduce the company's daily cash flow.
Precisely. And the other major adjustment is the amortization of purchased intangibles, which is basically just an accounting mechanism for writing down the value of past acquisitions over time.
So again, no new cash is leaving the door today for a company they bought, say, 3 years ago.
Exactly. So when you strip away the stock-based compensation and that historical amortization, you get to their non-GAAP operating income.
And what does that number surge to?
It surges to $395.4 million.
Wow.
And when you divide that by the total revenue, boom, you establish that robust 45% margin profile.
I mean, it just tells us that the day-to-day operation of delivering this software to pharmaceutical companies is wildly, incredibly profitable.
It's a cash machine.
Okay, so that explains the current math. But to understand the strategy, the big divorce we mentioned earlier, we have to look at how they are trying to expand that margin even further.
Right.
I want to introduce an analogy here to kind of ground this for you listening. Imagine a massively successful restaurant, like 3 Michelin stars, booked out months in advance.
Sounds great.
But for the last 10 years, they've been renting their building. And the landlord is taking 15% of their gross profits every single month.
A heavy tax.
Finally, the restaurant owners look at their bank account and say, you know what? We have enough capital. We don't need the landlord anymore. We were going to buy our own building outright and keep that 15%. That seems to be the exact mechanical logic behind Veeva erasing what I like to call the horizontal tax.
That analogy perfectly maps the historical relationship between Veeva and Salesforce.
Right, because Salesforce was the landlord.
Exactly. To understand why this divorce is happening, we really have to look back at how Veeva started. When Peter Gassner founded the company, he realized the pharmaceutical industry desperately needed a modern customer relationship management tool, a CRM.
Because they were using clunky, outdated stuff.
Right. But building the underlying database architecture, the secure cloud servers, the raw plumbing of the software that would take years and hundreds of millions of dollars.
Money a startup doesn't have.
Right. So he went to his former employer, Salesforce, which had already built the best horizontal CRM plumbing in the world.
Oh, wait, he used to work at Salesforce?
Yes, he did.
Yeah.
So he basically said, let me build a hyper-specialized pharma-specific app on top of your generic database.
That's fascinating.
That's a brilliant move at the time. It allowed Veeva to get to market incredibly fast. They built Veeva Commercial CRM on the Salesforce platform.
But the cost of that speed was a revenue-sharing agreement.
The landlord tax. Every time Veeva sold a seat to a pharma rep, they were paying an estimated 12 to 15% of that commercial revenue directly back to Salesforce in licensing fees.
Which, is totally fine when you are a scrappy startup doing $20 million in revenue. But when you are a multi-billion-dollar behemoth, handing over 15% of your core commercial revenue to another tech giant has got to be agonizing.
Oh, it becomes a structural margin ceiling. You simply cannot optimize your profitability when a third party is taking a toll on every single transaction.
Right.
So we arrive at the strategic internalization. Veeva made the monumental decision to build their own native database infrastructure from scratch, which they call the Veeva Vault platform.
So by abandoning the Salesforce infrastructure and moving everyone over to their own proprietary vault, they intentionally erased those historical licensing fees.
They are buying the building.
Okay, I definitely understand the financial motivation of cutting out the middleman. But how does this change the actual software? I mean, if I'm a pharmaceutical executive, do I really care whose underlying code my dashboard runs on as long as it works?
Oh, the executives care deeply. Because owning the infrastructure fundamentally changes the power of multi-tenant software scaling.
Okay, break that down for me. What does that actually mean in practice?
Let me give you an example. In the old fragmented model, a pharmaceutical company might use Veeva for their clinical trials, right? But those trials were housed on one specific database architecture.
Okay.
Then they use the Veeva CRM built on Salesforce to manage their sales reps.
Two completely different software languages, essentially.
Two different languages, two completely different databases. Now imagine a critical piece of data. Let's say a physician reports a severe adverse reaction to a drug during a phase 3 trial.
A huge deal.
Huge deal. In the old world, moving that specific data point from the clinical trial database, routing it into a strict regulatory FDA filing system, and then immediately pushing an alert to the iPad of the sales rep who visits that specific doctor.
Sounds like a nightmare.
It requires massive, expensive, custom IT integrations. You are essentially building custom digital bridges between different islands.
And custom bridges break. They require maintenance. Like every time Salesforce updates their code or Veeva updates theirs, the bridge might collapse.
Exactly. It creates immense friction and costs the pharma company millions in IT consulting fees.
Yeah.
But with the Vault architecture, Veeva controls the entire ecosystem natively. It is a unified metadata architecture.
So everything is under one roof.
That means the clinical trial, the regulatory filing, and the CRM are all sitting in the same building speaking the exact same language.
Wow.
That adverse reaction data point flows seamlessly and instantly across all applications without any custom integration needed.
So it's pure vertical integration. They aren't just selling the application on top anymore. They own the entire technology stack from the raw server data up to the pixels on the screen.
Yes. And that drives incredible operational leverage as the software scales. They only have to write a piece of code once, and it deploys across the entire life sciences ecosystem without having to check if it's compatible with Salesforce's underlying mechanics.
Okay, this brings us to a really fascinating pivot point in our investigation. Because we have an incredible 45% operating margin, we have a highly predictable recurring revenue engine.
Right.
They are cutting out the landlord to save a fortune in licensing fees, and the unified architecture makes the product objectively better for the client.
It does.
So if everything is so great, why is the market sweating? Why does the stock chart look so volatile lately? This brings us to what we are calling the backlog paradox.
The paradox exists because Wall Street absolutely hates uncertainty. And Veeva has introduced a massive multi-year window of operational uncertainty.
To migrate?
Right. To understand it, you really have to grasp the sheer terrifying scale of the global migration currently underway. Veeva doesn't just get to snap their fingers and move everyone to the new Vault platform.
If only it were that easy.
They have to physically migrate the entire historical databases of their legacy commercial customers off of Salesforce and onto Vault CRM.
And there is a ticking clock, right? Like they can't just take their time and do this leisurely over the next 20 years.
No, the timeline is strict and it's legally binding. The formal partnership agreement with Salesforce actually expired in September 2025.
Oh, wow.
So they are currently operating in a strict wind-down period. This means there is a hard cap on the number of new seats they can sell on the old Salesforce platform.
And when does that wind-down period end?
It definitively, absolutely ends in September 2030. By late 2030, Veeva cannot sell or support applications utilizing Salesforce infrastructure to anyone, period.
I really want to focus on the logistics of that because the phrase data migration sounds so sterile, you know? Like dragging a folder from one hard drive to another.
It's far more complex than that.
Right, because migrating a global pharmaceutical company's database, their entire commercial brain, containing decades of doctor interactions, prescription histories, legal compliance logs that sounds like trying to change the engine on a commercial jet while it's flying over the Atlantic Ocean.
That is...
If you drop a single wrench, the plane goes down.
That is an apt analogy. I mean, if a migration fails, or if data is corrupted during the transfer, a pharma company's entire global sales force is grounded.
They literally couldn't do their jobs.
Right. They can't legally give out drug samples. They can't track physician interactions. It is a catastrophic resume-generating event for a chief information officer.
Resume-generating event. I love that phrase. It means you're getting fired.
Yes.
Yes.
Which is exactly why the success metrics the V is currently reporting are so critical to their survival right now.
Well, let's look at those numbers, because the sources indicate they are actually pulling this off.
They are.
They have successfully migrated over 40 customers already. They have over 115 live customers operating on the new Vault CRM. And in just the recent quarter, they won 27 new CRM customers.
That's solid momentum.
But the stat that really jumped out at me is at the enterprise level. 10 of the top 20 global biopharma companies have fully committed to Veeva, and 2 of those top 20s are already live globally.
Yeah, and getting a top 20 biopharma live globally is really the ultimate proof of concept, primarily because of the regional complexity.
What do you mean by regional complexity?
Well, a CRM deployment for a global giant isn't just one uniform system. The privacy regulations regarding patient data in Japan, for instance, are vastly different from the GDPR regulations in the European Union, which are different from EPA in the United States.
Oh, right. So it's a legal minefield.
To successfully port a system across all those jurisdictions simultaneously without breaking compliance proves that the Vault architecture is highly resilient.
Okay, let me play devil's advocate here for a second. If the tech is so resilient and the top pharma companies are signing these contracts, why did we see top-line revenue recognition slow down? Why is there friction in the immediate financials?
Because the execution itself absorbs oxygen.
Explain that.
The administrative friction of moving a top 20 pharma company requires intense, specialized technical support. Veeva has to deploy its best engineers and its top go-to-market teams to physically hold the hands of these clients through the migration.
You can't just email them a link to download the new software.
Exactly.
So the people who would normally be out selling new add-ons or upselling features are stuck doing the plumbing work on the migration.
Partly that, yes, but it also elongates the sales cycles for the clients themselves. I mean, put yourself in the shoes of that pharma CIO.
Exactly.
Your primary mandate right now is ensuring the CRM migration doesn't crash the company. Even if Veeva comes to you with a brilliant new analytics package or a new marketing software tool, you are going to delay that purchase.
Not right now, guys. We have bigger fish to fry.
Exactly. You will say, let's get through the 2027 CRM migration first, and if we survive that, we can talk about buying more software in 2028.
So it creates a temporary air pocket in their upsell motion. The clients are hitting pause on discretionary spending while they manage the foundational shift.
Right. It creates a massive operational drag. So while Veeva is winning the accounts and securing the contracts for the next decade, the immediate top-line revenue recognition slows down because those auxiliary purchases are delayed.
Which leads directly into the sentiment decoupling and the valuation reset we've seen in the stock over the past year.
Yes, it does.
Looking at the data, management actually raised their full-year guidance. They are projecting total revenue to land between $3.35 billion and $3.645 billion.
Very strong numbers.
By all accounts, the business is growing. Yet the stock recently experienced a sharp 13% drop, falling into the $163 to $172 zone. How do you reconcile a company raising its financial guidance while its stock plummets?
This is a textbook example of sentiment decoupling from the fundamental reality of the business.
Yeah.
You really have to look at the broader macroeconomic picture.
Because it's not just Veeva.
Right. That drop isn't entirely about Veeva's internal execution anxiety. It is heavily influenced by a broader software sector phenomenon known as multiple compression.
Let's define multiple compression for the audience, because I think a lot of people see a stock go down and immediately assume the company is losing money.
Sure. So multiple compression happens when the market decides it is no longer willing to pay as high a premium for a company's future earnings. Let's say a software company earns $1 per share. 2 years ago, when interest rates were near zero and money was essentially free, Wall Street might have been willing to pay $50 for that $1 of earnings, a price-to-earnings ratio of 50.
Because there was nowhere else to get a return, so investors just piled into high-growth tech.
Exactly. But today, with higher interest rates and tightening enterprise IT budgets across the globe, Major investment banks are systematically downgrading top-tier software platforms.
Right.
The market looks at that exact same $1 of earnings and says, I'm only willing to pay $30 for that now. The company's earnings didn't drop. The company's still completely healthy. But the multiple the market assigns to it compresses.
So when you combine that broader macro industry slump with the specific institutional anxiety over the logistical complexities of Veeva's CRM migration, you get a double whammy.
You do. It brought Veeva's price-to-earnings ratio down aggressively into the 29 to 32 times range. The market is aggressively pricing in the near-term transition friction and completely ignoring the fact that the underlying cash flow generation is stronger than ever.
So Wall Street is obsessing over the migration turbulence, essentially staring at the potholes in the road.
Yeah.
But Veeva management isn't just sitting still managing the divorce. They are actively hunting for new revenue frontiers. Which I want to transition into now what our sources outline as forensic asset ingestion.
The great topic.
Specifically, I want to look at how they are acquiring new AI capabilities. Let's highlight the recent $90 million net cash purchase of a company called Ostro, officially known as Rise Healthcare Tech, Inc.
The Ostro acquisition is honestly a perfect microcosm of Veeva's capital allocation strategy. All right. If we perform a strict forensic audit on the mechanics of this deal, it is brilliant.
Walk me through it.
Ostro is fundamentally an AI-driven chat experience,
Right.
but it's not a generic chatbot. It is specialized software embedded directly onto biopharmaceutical brand websites.
Okay.
Its sole purpose is to instantly capture, intercept, and answer patient and doctor inquiries in a highly compliant way.
Let's make this tangible for the listener. Give me a scenario where this is used in the real world.
Imagine a general practitioner is working late at night. She has a patient with a rare kidney condition, and she is considering prescribing a newly approved biologic drug.
Okay.
But she needs to know a very specific, nuanced contraindication regarding kidney function before she writes the prescription. It's midnight. She goes to the drug's website. Historically, she would have to fill out a Contact Us form or leave a voicemail for a pharmaceutical sales rep and wait 2 days for an answer.
By which point she might have just prescribed a different drug from a competitor.
Exactly. You lose the sale. But with Ostro embedded on the site, an AI agent trained specifically on the FDA-approved medical literature for that exact drug instantly engages her.
Oh, wow.
It answers the complex medical question compliantly at midnight, allowing her to make the clinical decision immediately.
The value proposition for the pharma company is obvious there. But let's look at the math. The sources say Veeva paid $90 million in net cash for this. What is the actual financial impact on Veeva's top line?
Mathematically, management projects Ostro will contribute roughly $10 million in revenue for the remaining 3 quarters of the current fiscal year.
Just $10 million.
Yeah. In fact, that specific acquisition is driving about 2/3 of the $15 million increase in their commercial cloud subscription revenue guidance for the year.
I have to pause on the math here. They paid $90 million for something that is only going to bring in $10 million over 9 months.
Yes.
That implies a revenue multiple of maybe 6 or 7 times. In a vacuum, paying 7 times revenue for a chatbot sounds kind of steep. Why is this a good deal?
It's a good deal because of the strategic structure and the data loop it creates. Veeva didn't just buy a chatbot. They bought a proprietary data engine.
Okay, explain that.
First, they are operating Ostro as a startup within Veeva. They left the original founders in charge, and the unit reports directly to the CEO of Veeva.
Which keeps the team agile and insulated from slow corporate bureaucracy.
Precisely. But the true genius is how the technology natively integrates into the broader Veeva commercial cloud.
This goes back to the multi-tenant architecture we discussed earlier. It's not a standalone product sitting on an island.
Exactly. It is deeply integrated. Let's go back to our late-night doctor scenario.
Okay, the kidney drug.
Right. If the Ostro AI determines that the doctor's question is too complex or touches on off-label use that the AI isn't legally allowed to discuss, it doesn't just say, I don't know.
What does it do?
It seamlessly packages the entire context of that conversation and routes it instantly as a high-priority lead directly into the Vault CRM of the specific human sales representative assigned to that doctor's territory.
Oh, man. So when the rep wakes up the next morning, they have a notification saying, Dr. Smith was asking about kidney contraindications at midnight. Here's the transcript. Call her immediately.
Exactly. Furthermore, this creates a massive aggregated proprietary data generation loop that Veeva calls commercial evidence.
Commercial evidence, break that down for me.
Well, when you have hundreds of thousands of these AI interactions happening globally across hundreds of drug websites, the pharmaceutical company suddenly has a real-time heat map of exactly what doctors and patients are confused about.
Oh, that's incredibly valuable.
They can see, mathematically, what specific barriers are preventing patients from accessing the medication. If 50 doctors in Ohio all ask the AI the same specific dosing question, the pharma company knows their marketing materials are failing and they can instantly adjust their strategy.
That is data that used to be completely lost or manually aggregated by massive call centers over months. Now it's instantaneous.
Exactly.
Okay, this naturally brings us to a major industry buzzword, heavily featured in the source material, agentic labor. I am inherently skeptical of AI buzzwords because, let's be real, every tech company on Earth is promising that AI will revolutionize their business.
It's definitely overused.
So is this new Veeva Falcon platform just another hyped-up generative AI feature, or does it actually change the unit economics of the pharmaceutical industry?
Your skepticism is completely warranted, but Veeva Falcon is fundamentally different from the generative AI tools the public is used to.
How so?
It is not a generic language model designed to write emails or generate images. Falcon represents highly specialized agentic software. The key word is agentic.
Meaning it has agency.
Yes, it means the software acts as an autonomous agent. It is designed to fully replace manual, high-volume, repetitive industry labor, bounded by strict medical and regulatory guardrails.
Give me a concrete example of the kind of labor we are talking about here. What jobs is this actually doing?
Let's look at the processing of clinical trial documentation or the tracking of adverse safety cases. Let's say a pharma company is running a massive global clinical trial with 20,000 patients.
Okay.
Every time a patient visits a clinic, a nurse fills out a complex medical form. Historically, a pharmaceutical company would outsource the data entry and compliance checking of these forms to a massive contract research organization, a CRO.
Which means paying for rooms full of hundreds of human beings staring at screens.
Thousands of human hours spent reading documents, extracting data, cross-referencing it against safety protocols, and manually entering it into a database.
And humans get tired.
It is expensive, it is slow, and humans make data entry errors. Veeva Falcon is an autonomous software agent built to execute those specific workflows natively within the Vault platform.
So the AI does it all.
The AI ingests the form, understands the medical context, flags anomalies, and routes it to the final database without human intervention.
But wait, if they are replacing humans with software, how does Veeva make money? Traditional SaaS companies charge a monthly fee for every human using the software, the seat license.
Right, the per-user model.
If Falcon eliminates the humans, the pharma company needs fewer seat licenses. Doesn't that cannibalize Veeva's own revenue?
That question cuts to the absolute core of the AI transition in software. It requires a pivotal shift in the business model. Veeva cannot price Falcon based on seats. Instead, they will utilize a high-margin, usage-based monetization model. Falcon will likely be priced by the document processed or by the case resolved.
Wow, so they're directly monetizing the productivity gain itself.
The math is incredibly compelling for the client. I mean, if a pharma company currently pays a CRO $50 in human labor costs to process a single safety case, Veeva can come in and say, Falcon will process it instantly with zero human error for $10.
That's a no-brainer.
The pharma company saves $40 per case, fundamentally shifting the cost structure of their operations. And for Veeva, it opens up a massive new revenue stream that scales with the volume of industry activity, not just the headcount of their customers.
That is a massive paradigm shift. They are essentially transitioning from selling tools to selling the labor itself.
Exactly.
But, you know, while the CRM migration drama and this new flashy AI agentic labor get all the headlines, I feel like we are ignoring the structural foundation of the company.
We can't forget the bread and butter.
Right. We need to talk about the hidden engine of Veeva. Let's transition to what the outline calls operational ingestion. It seems like the real anchor keeping the ship steady during this turbulent transition is their R&D and quality division.
It absolutely is the anchor. If you only look at the CRM divorce, you miss the true power of the enterprise. If we map out the revenue mix, R&D and quality solutions now account for roughly 54% of Veeva's total subscription revenues.
Wait, really? More than half?
It is actually the majority of their recurring business, and it is growing steadily.
For someone outside the life sciences, what exactly are these R&D systems doing? What makes them so critical?
Well, They have systematically captured the most mission-critical systems in the life sciences lifecycle. We are talking about the software that literally allows a drug to be tested and approved.
Okay, give me some examples.
This includes clinical trial management systems. It includes the electronic trial master file, or eTMF, which is the master digital record of a trial.
Like the legal paper trail.
Exactly. It includes electronic data capture, EDC. It includes the software that formats complex, thousands of pages long regulatory submissions for the FDA, and the systems that handle post-market safety reporting once the drug is being sold to the public.
So the stakes here are vastly different than the sales software. If your CRM goes down for a day, your sales reps are annoyed, and maybe you miss out on a few doctor visits.
Right.
If your eTMF goes down or your data is corrupted, your billion-dollar clinical trial halts. You are in direct violation of federal FDA regulations.
The operational risk is highly asymmetric. These specialized, highly regulated software integrations provide Veeva with an immediate, stabilized baseline revenue. Because these are FDA-regulated systems of record, replacing them carries massive, almost unthinkable compliance risks for a pharma company.
You do not rip out the software holding your clinical trial data unless it is an absolute emergency.
No, you don't.
Which means churn the rate at which customers cancel their subscriptions is basically non-existent.
It is near zero. This dynamic completely avoids the ramping friction you see in newer, non-industry specific applications. Once Veeva is embedded in a company's clinical trial process, they are locked in for the life of that drug's development cycle.
And in pharmaceuticals, a development cycle can easily last a decade or more.
Decades. Plural, sometimes.
Okay, understanding that lock-in makes the next point deeply fascinating. I want to raise a specific, provocative question based on the corporate structure outlined in the proxy statements. Veeva does not operate as a standard C corporation.
No, they do not.
They operate as a Delaware Public Benefit Corporation, a PBC.
Yes, they were actually the first publicly traded company to convert to a PBC structure a few years ago.
By legal definition, a public benefit corporation forces the board of directors to balance the financial interests of the shareholders with the interests of other stakeholders, specifically their customers, their employees, and the broader communities they serve.
That's the charter, yes.
From a ruthless Wall Street perspective, doesn't forcing the board to care about employees and customers directly conflict with maximizing quarterly profits for the shareholder? How is Wall Street okay with a company that legally says profit isn't our only motive?
It is a fascinating dynamic, and it routinely confuses short-term traders. While it might seem counterintuitive to a pure, aggressive profit maximization model, the public benefit corporation structure actually acts as a unique, highly durable operational moat for Veeva over the long term.
I need you to connect those dots. How does being nice to other stakeholders create a financial moat?
Well, by legally prioritizing the long-term health of the life sciences industry alongside financial returns, Veeva actively prevents itself from making decisions that squeeze customers for short-term gains.
Okay.
In standard enterprise software, a common tactic is the vendor lock-in squeeze.
Oh, I know this one.
Right.
Right.
Once a software company knows you can't easily leave, they jack up the renewal prices by 30% just to hit a quarterly earnings target. They know it will anger the customer, but they also know the customer is trapped.
And the pharma companies know they are trapped with Veeva's R&D software.
Exactly. But because Veeva is a PBC, they have a legal mandate not to exploit that leverage. It forces deep, long-term stakeholder alignment. It builds an immense amount of trust.
I see where this is going.
In an industry as risk-averse, secretive, and heavily regulated as pharmaceuticals, that trust translates into incredibly high retention enterprise outcomes. A pharma CIO is willing to sign a massive 10-year contract migrating their global CRM to Veeva Vault because they trust Veeva won't suddenly double the price in year 4.
Because they literally can't legally without violating their charter.
Right. It essentially locks in customer loyalty through 2030 and beyond because the customers know Veeva is legally bound to act as a partner, not an extractor.
It is essentially weaponized trust. They are using corporate governance to disarm the natural skepticism of the buyer. That is brilliant strategy.
It really is.
Okay, let's pull all these threads together. They have this incredibly sticky, high-retention R&D revenue. They have weaponized trust through the PBC structure. They're erasing the Salesforce tax. And they have this 45% operating margin engine churning out cash every single
A lot of cash.
Let's transition to how they are actually deploying that mountain of cash to dominate the board. Let's look at capital allocation and what we're calling the share cannibal playbook.
To understand their offensive playbook, we have to dissect the balance sheet, which reveals the elite structural financial power of this company. Veeva is not operating from a position of defense.
Right.
They currently sit on a $7.3 billion cash-rich, completely debt-free balance sheet.
Let me repeat that for the audience. $7.3 billion in cash, zero debt.
It's zero.
In today's macroeconomic environment, where interest rates have been aggressively hiked to fight inflation, that is a fortress.
It is an absolute fortress. The cost of capital for their competitors has skyrocketed, but Veeva doesn't care because they fund everything internally.
Yeah, they're their own bank.
This positioning enables them to act as an aggressive cash-generative compounder. They are taking those massive operating cash flows and deploying them directly into high-level AI-driven software development like the Falcon project we discussed.
Right.
In fact, management notes in the filings that they spend roughly twice as much on R&D and product development as they do on all other business areas combined.
Which is a luxury they can afford because they don't have the heavy drag of external debt servicing. I mean, if they had $3 billion in debt, they would be paying hundreds of millions of dollars a year in interest to a bank just for the privilege of existing.
Exactly.
Instead, those hundreds of millions go directly into hiring better AI engineers. And because they're a pure software company, they don't have traditional manufacturing capital requirements. They don't have to build multi-billion-dollar semiconductor fabrication plants or warehouses.
Precisely. And recently, they received a massive, almost unexpected regulatory tailwind regarding their cash flow. It involves the legislative shifts around R&D tax deductions, specifically referenced in the context of the OBDBA legislation pushing to restore immediate expensing.
Let's break down the tax mechanics here because tax law drives massive corporate behavior.
It does. So under the Tax Cuts and Jobs Act of 2017, a provision went into effect in 2022 that required companies to amortize their domestic research and development expenses over 5 years, rather than deducting them immediately in the year they were incurred.
So you couldn't take the full write-off up front?
Right. This artificially inflated taxable income in the short term, acting as a massive cash flow drain for heavy R&D spenders like software companies. However, recent legislative maneuvers and IRS guidance shifts, allowing for the immediate deduction of certain software development and domestic R&D expenditures, provided a massive reversal.
How big of a reversal?
This change acted as a roughly $145 million tailwind to Veeva's operating cash flow compared to the previous year.
So the shifting tax landscape essentially handed them an extra $145 million in liquid cash to play with simply because they do their engineering domestically.
Yes.
Compare this financial positioning to the legacy enterprise software models. The older tech giants are often heavily debt-burdened from years of making expensive acquisitions to try and buy growth, and they struggle with significantly lower operating margins.
That contrast is vital to the investment thesis. While legacy competitors are frantically using their cash to pay down variable rate debt, Veeva's elite capital allocation allows for highly aggressive, shareholder-friendly actions. Specifically, they have armed themselves with a $2 billion share repurchase authorization.
The share cannibal playbook. Walk me through the mechanics of why a company buys back its own stock and why doing it right now is so potent.
Well, remember our discussion about multiple compression.
Where the market won't pay as much for earnings.
Right. Wall Street is broadly lowering the valuation multiples they are willing to pay for software earnings due to macroeconomic fears and the CRM migration anxiety. Consequently, Veeva's stock price has dipped, despite the business generating more cash than ever. Veeva management looks at their own stock and realizes it is trading at a discount to its intrinsic long-term cash flow value.
So instead of buying another company, they buy themselves.
They use their massive cash pile to aggressively buy back their own stock on the open market and retire those shares. They're literally cannibalizing their own share count.
Right, shrinking the pie.
By reducing the number of total slices in the pie, every remaining slice becomes inherently more valuable. For long-term capital allocators utilizing what we call the value catch model, this creates immense value.
You are owning a larger and larger percentage of a highly profitable debt-free monopoly simply because the company is retiring shares while the broader market is temporarily pessimistic.
That's exactly it.
So synthesizing everything we've uncovered, We've dissected the 45% margins, the strategic brilliance of the native Vault architecture, the incredibly sticky R&D software that anchors the business, the evolution into AI agentic labor, and the fortress balance sheet.
We covered a lot of ground.
Let's bring this deep dive to a close by boiling the investment case down to a single, powerful analogy. Based on everything we've unpacked, Veeva has essentially constructed the unassailable, mission-critical digital toll booth for the global life sciences industry.
The digital toll booth is the perfect framework. Every single piece of data in the modern pharmaceutical industry, from the initial discovery of a molecule in a phase 1 clinical trial, flowing through the thousands of pages of an FDA regulatory submission, all the way to the final commercial sales pitch delivered to a doctor on a tablet, must pass through their infrastructure.
And Veeva collects a coal at every single gate.
At every gate.
So what is the final verdict for someone analyzing this company today?
The final verdict is this. Despite the current valuation multiple compression and the highly localized Wall Street panic regarding the near-term SaaS environment, we are looking at an enterprise acting as a cycle-resistant, highly profitable software powerhouse. Their deep vertical integration makes them incredibly difficult, almost impossible to rip out. At current valuations, fueled by their aggressive share buybacks, it represents a structural value play for capital allocators who possess the patience to look past the immediate transition noise.
But, as always on this show, we must define the risk before we look at the reward. Nothing is guaranteed. What are the specific execution hurdles Veeva must navigate to realize this dominant long-term vision?
There are 3 primary execution risks that any allocator must monitor closely. First, the competitive landscape is not static. We must acknowledge the intense competitive counterattack from the Salesforce IQVAA alliance.
Right. Salesforce is not just going to wave goodbye to $1 billion in pharma revenue.
Exactly. As Veeva moves to its own platform, Salesforce has teamed up with IQVAA, another massive player in the healthcare data space. They are aggressively trying to poach legacy Veeva CRM seats by offering integrated platforms that leverage IQVAA's massive industry-standard healthcare data sets.
It's a data war.
It is. Veeva currently maintains an incredibly high win rate in these head-to-head battles, but Salesforce is a formidable, well-capitalized enemy fighting for its turf.
The data wars are just beginning. What is the second risk?
The second is the pure logistical burden and potential for business disruption during the global migration. Moving the commercial brain of a top 20 pharmaceutical company to a native architecture by the 2030 wind-down deadline is an engineering tightrope walk.
There is zero room for error.
Any major software outages, data losses, or compliance breaches during this migration window could severely damage Veeva's reputation and halt their momentum entirely.
The airplane engine replacement has to go flawlessly, dozens of times over. And the third risk?
The third risk relates back to our discussion on corporate governance. The regulatory scrutiny and unique fiduciary dynamics inherent in operating as a public benefit corporation. While we establish that it creates a long-term mode of trust, it also means that the board of directors may occasionally make strategic decisions that prioritize stakeholder stability over aggressive financial engineering.
Give me an example of how that might upset Wall Street.
Well, in a difficult macroeconomic year, a traditional tech company might lay off 10% of its workforce to artificially boost its profit margins and pop the stock price.
We see that all the time.
Veeva, as a PBC, might choose to retain those employees and absorb the margin hit to maintain stability for their customers' ongoing migrations. A traditional company might raise prices aggressively. Veeva might hold prices steady.
Right.
These decisions are structurally sound for a 10-year horizon, but they can deeply frustrate short-term hedge funds looking for an immediate earnings beat.
Which means, as an investor, your time horizon has to match the company's governance structure. You have to be aligned with the slow, steady compounding.
Yeah.
I want to leave you, the listener, with a final provocative thought to mull over as you digest all of the strategy, the numbers, and the architectural shifts. As artificial intelligence continues to advance at a breakneck speed, with models getting smarter every single week, we are approaching a massive fork in the road for the future of enterprise technology. Will the future belong to massive, horizontal jack-of-all-trades, AI models, the generic platforms that try to do everything for everyone, from writing marketing copy for a shoe company to scheduling meetings for a law firm? Or will heavily regulated, complex industries with zero margin for error, like pharmaceuticals, aerospace, or nuclear energy, demand hyper-specific, vertically integrated AI? Will they demand AI that inherently understands the complex legal rules, the specialized vocabulary, and the literal life or death stakes of their specific game? Because if the future bends toward specialization, the company that owns the underlying vertical data architecture might just own the entire future of the industry. Risk defined, portfolio protected.